now going to conclude Chapter 4 by covering some very important but not too lengthy learning objectives. In this module, we're going to look at learning objectives 4 through 7. And the first one is preparing the post-closing trial balance. As I said at the end of the last module, once the closing entries have been journalized and posted, all accounts that remain are the permanent accounts. But nonetheless, we still need to prepare a trial balance to ensure that the recording process resulted in debits equal to credits. So after all these closing entries have been journalized and posted, we prepare the post-closing trial balance. And again, the purpose is to ensure that the equality of the permanent account balances are carried forward to the next period. And the post-closing trial balance, as we said, will only include our balance sheet accounts, because all of the temporary accounts, again, the temporary accounts are revenues, gains, losses, and dividends, expenses, and dividends have a zero balance. So these are all closed out. Revenues, gains, expenses, losses, and dividends are your temporary accounts, and they've been closed out at the end of the period. So if we look at Smart Chart's post-closing trial balance, again, the only accounts that remain are balance sheet or permanent accounts, and debits are equal to credits. So to summarize, only balance sheet accounts remain after the closing. Revenue and expense accounts, the temporaries, have zero balances, and dividends, of course. And the books, of course, are ready for the next fiscal period. And again, don't forget dividends as well. Once again, balance sheet accounts are permanent. They carry over period after period. And that means that you start 2015 with $12,200 in cash, $1,800 in receivables, and so on. So the ending balance at 12/31/2014 equals the beginning balance of January 1st of 2015. Okay? Now, in our next learning objective, we're now going to summarize the accounting cycle. At this point, the accounting cycle is completed. You know, we were showing you pieces of the accounting cycle as we were moving through, and now we're going to summarize and finalize that cycle. So we begin with the opening account balances. And don't forget, I mean, if we think about going way back to the first chapter, we started with an economic event. We looked at source documents, and we made our recordings. We had our journalization and posting. So that's where we're going now. We start with the beginning balances. So you have some opening balances. Or in the case of Smart Touch, you just started your business. Then we analyze and journalize transactions. So we engage in economic activity that generate transactions, of course. Those transactions will result in documentation. Those documents then are recorded. You know, again, we have to make sure we have an accounting event that's subject to being recorded, that it could be measured and should be recorded properly in the statements. Next, we post them to the ledger, the journal accounts, We make the journal entries in number 2, then we post them to the ledger. Then we have our unadjusted trial balance to prove the equality of the debits and credits, not the accuracy. We could prepare an optional worksheet if we so desire, and by doing that, it facilitates, as we said, the preparation of the actual adjusting entries, and the financial statement preparation is also facilitated. Then we journalize and post our adjusting journal entries. We prepare the adjusted trial balance, again, to prove the Debits are equal to credits at this point. We prepare the financial statements directly from the adjusted trial balance. Then we journalize and post the closing entries. And then finally, we prepare the post-closing trial balance where we only have the permanent accounts. And that completes the accounting cycle. So at this point, we are completely finished with one fiscal year, and now we could start another. So when you reach step or point 10, as we just did a few minutes ago, when the temporary accounts are closed, and those temporary accounts have a zero balance, we now begin the next accounting period, and these are only permanent accounts. Now, within our discussions during this chapter, we did mention the classified balance sheet. And in Learning Objective 6, we're going to look at something known as a current ratio. It is also known as the working capital ratio. And that is used to assess liquidity. If you remember, we talked about matching maturities. And the current ratio is the ratio of current assets to current liabilities. Current assets are assets expected to be liquidated, or in other words, converted into cash, sold or consumed within 1 year or operating cycle, whichever is longer. Current liabilities are obligations that are due and payable within 1 year operating cycle, whichever is longer. And of course, the idea is to match maturities. We're hoping that your current assets, your liquid assets, are available to pay off current liabilities. And again, current liabilities will typically use current assets in their liquidation. So for example, if you had $495,269 of current assets at September 25th of 2010, and you had $238,055 of liabilities that are current at that same point, your working capital, or your current ratio, and this is also called the working capital ratio, which I'll get to in a second, is 2.08. So it's actually 2.8 to 1. So you have over 2 times the number of current assets than you have current liabilities. You know, until we know the composition of those current assets, we can't be sure of the quality of this ratio. By the way, these ratios, when you look at financial ratios, they do not provide answers. They raise questions. So here are the questions that you should have when you look at this current ratio. On the surface, it appears that the company's liquidity is sound, that they have sufficient current assets to cover their current liabilities. A couple of problems. One, we don't know if this is in line with the industry average. We don't know if, unless we take the ratio from last year, which I'll do right now, you're not sure whether or not it is increased or decreased. And in fact, if you do take the ratio right now from 2009, it's 4.25 times, or should say 4.25 to 1. So this ratio, as you can see, declined or deteriorated, and we're not sure what the norm is. What's the industry average? Is it around 4? Is it around 2? So we're not certain whether or not these ratios are sound. In addition, we're not sure about the composition of those current assets. What if most of those current assets are prepaid insurance or prepaid rent? Cannot really sell that. You can't sell prepaid insurance. If you prepaid 3 years insurance in advance, that can't be sold. So the assets in here may not be all that liquid. So you'd have to look at the composition of the current assets. Now I mentioned the term working capital. Another term that we use is working capital. Working capital is current assets minus current liabilities, and that is sometimes used as a measure of liquidity. So in this case, if we wanted to calculate working capital in 2010, it is 257, 214, and working capital in 2009 was 410, 924. And again, working capital is another measure of liquidity. What we're trying to do, as I said earlier, is match maturities to be sure that you have sufficient current assets to cover your current liabilities. And finally, in the appendix to Chapter 4, we've got reversing entries. And what are reversing entries? Reversing entries is a bookkeeping tool that helps to simplify the recording of routine or standard journal entries going into the next period. Now, these are not required, but they are the opposite of accruals. They're not required by GAAP, and as I said, they're really for convenience or to make your routine journal entries much easier in the next period. Now notice they're the opposite of accruals. So in other words, only accruals get reversed. So you're reversing adjustments to accruals. Not deferrals. So reversing entries will not apply to depreciation. Reversing entries will not apply to prepaid insurance, etc. So the steps, as you know, we record the accrual adjusting entry at the end of the period, and at the beginning of the very next period, we reverse that entry out, and then we record the actual cash flow or payment or cash receipt in the next period without even referring to the previous adjusting entry. And in fact, some companies don't even make the adjusting entries formally in their accounts. They call them worksheet entries, although they're not necessarily paper and pencil worksheets. But a lot of companies will, in effect, not journalize and post their adjustments so that next year the entries are clean. But this is more, I guess, correct in the sense that you would be able to record the adjustment and then make the appropriate reversal so that they're made at the beginning of the next accounting period and they are the exact opposite of the accrual entry. And as I said, the purpose is to simplify the recording of a subsequent transaction that is a routine, a standard payroll every month or every week. Payroll looks the same. Payroll always looks like a debit to salary expense, credit to cash. Debit salary expense, credit to cash. However, if you have an accrual, part of that cash might be paying off a previously accrued liability, and the bookkeeping system, unless you do a manual override, is not going to recognize that adjustment. So we use reversing entries for accrued revenues and accrued expenses. As I said, they will not, typically there are always exceptions. They do not apply to deferrals. So here's an illustration. Let's assume that an adjusting entry is made on December 31st for the first week of a bi-weekly $10 payroll. So the payroll is 2 weeks, $10, so you divide that by 2, so that you have 1 week earned but unpaid at the end of the accounting period. So you have 1 week of a 2-week payroll that was earned by your employees, therefore incurred by the company, unpaid, unrecorded at the end of the accounting period. So that for 2016, you have to debit salary expense and credit salary payable to ensure that you have the correct salary expense for that period. Now, next period, the bookkeeping system is going to debit salary expense and credit cash. You can't, unless you go in and go to every let's say, subsidiary, every office, every unit of your company, and make those adjustments. So rather than making the manual override, what we'll do is we'll record a reversing entry. So once we close the account, notice what happens. And here's the important point. You debit income summary and you credit salary expense. So now salary expense is 0 for 2016. All right, that's gone, and you start 2017 with a 0 balance. But notice that there's a salary payable here. That's not getting closed out because that's a permanent account. So in 2017, what we do is we're going to reverse out the adjustment. The adjustment, if we go back up, was a debit to salary expense, credit to salary payable. Now we're going to reverse that by debiting the salary payable and crediting the salary expense. So in the next payroll, you make your regular entry. What will happen, the effect of that reversing entry is now, because you had a 0 balance, if you again, go back and remember that you have a 0 balance now in salary expense. $5 credit offsets the debit. It was closed out, so the balance is 0 going into 2017. When we hit 2017, we made the reversing entry, right below here. On the bottom of this screen, you got a debit to salary payable, credit to salary expense. So that the balance now in salary expense is credit. Now we know the normal balance of an expense is a debit. So, and as I said, there are exceptions, and here's one. So right now at this point, until you make the payroll paid or payment on January 8th, at the beginning of 2017, on January 1 of 2017, your salary expense has a credit balance. That's not its normal balance, but it's there for a reason. And the salary payable account has now been brought to 0 because of the reversal. So that when you make your regular journal entry here, this is your normal payroll, the regular payroll entry, debit salary expense, credit cash for 10. What happens when you debit salary expense and credit cash for 10? The expense for 2017 is 5, and that's the correct amount. Because don't forget, you have 1 week in 2016. You've already accrued that expense, and you have 1 week in 2017. Now, even though, and that's for 5, even though this says you're expensing the salary for $10, remember, you have that balance, the credit of 5. That means that the amount of expense that's reflected on the income statement at this point is $5. So the balance after the reversing entry is 5. Just like the balance here of salary payable is 0.